This listing is a testimony to the sophistication, depth, and dynamism of the financial landscape, one that continues to mature and present tangible wealth-building opportunities for a diverse range of investors. The journey towards today's listing reflects the ethos of Barita Investments Limited, the vision, collaboration, and the innovation. Our dedicated investment banking team worked tirelessly with all stakeholders to structure a bond that would not only meet the needs of the market, but also align with the client's financial goals. This listing is more than a financial transaction. It signals Barita's steadfast commitment to democratizing access to the capital markets, fostering financial inclusion, and promoting wealth creation across Jamaica and the region.
I'm pleased that you could be here today for the listing of not one, not two, not three, but 7 tranches of the bonds, Barita bonds on the JC bond markets. And you know 7 is a perfect number, so it is good. We are excited to have BIL, which is a listed company, having listed its ordinary shares on the main market, now listing these bonds on the bond market. And I'll tell you a little bit more about why we are excited. In fact, BIL has utilized all the markets of the exchange, which is a testament to their belief in the stock market, and that this is an avenue for mobilizing capital. BIL listed its ordinary shares on the JC main market on January 14, 2020 at a price of $2.50. Who can remember that? Hardly anybody. And that is after successfully raising $93.65 million. And it seemed like a whole lot of money then. Yes? The stock price is currently 70.41, an appreciation of over 2,700%.
Extremely grateful for the support that got us here. I first want to thank investors for continuing to place their confidence in us. I mean, Barita Investments is no stranger to the market. Marlene spoke about our first 4 years into the capital market with our IPO in 2010. But since then, we've returned to the GSE for capital several times. Actually, have done 4 takes at it, Marlene. We would have done 2 rights issues in 2019, actually, in March and September, both oversubscribed. We would have reopened the capital markets in 2020 with our landmark IPO, $13.5 billion. It was, at the time, a very daunting transaction. Therese would have led that transaction, and we would have followed it up the year after with an IPO that raised $10.8 billion. So we're no stranger to the market. That's that to say that our endeavors are built, right, on top of the confidence that investors have continued to place in us. It's not a responsibility that we take lightly. We are fiduciaries of your money. And as our slogan said, we'll continue to responsibly and prudently make that money work for you.
At Barita, we don't create seats, we build launch pads. The Barita Analyst program is where bright minds come to catapult their careers. This program is next level because it goes beyond theory. From day one, you'll rotate across critical departments: strategy, asset management, corporate finance, learning, leading, and delivering value.
When I joined the Analyst program, I thought I'd be doing mostly admin tasks, such as ensuring documents are in order, tidying up files, shadowing my boss, not a whole lot of action. However, from the very first day, I realized this was not going to be the case. I went straight into the action. Over the course of the program, I've done more than I could have expected. I have meaningfully assisted the team in completing numerous deals. I've written multiple research reports that have been published on the company's website, and most proudly and recently, I helped execute one of our biggest deals ever, the Barita bond. I was part of the structuring and distribution of that transaction. I helped to pitch a strategy and craft the story that secured investor confidence. That's real exposure, real responsibility. This program pushed me to grow fast and deliver even faster. It's not just about learning different aspects of finance. It's about playing a key role in strengthening and developing the Jamaican financial industry.
If you're hungry to grow and ready to rise,
Barita is where it begins.
This listing is a testimony to the sophistication, depth, and dynamism of the financial landscape, one that continues to mature and present tangible wealth-building opportunities for a diverse range of investors. The journey towards today's listing reflects the ethos of Barita Investments Limited, the vision, collaboration, and the innovation. Our dedicated investment banking team worked tirelessly with all stakeholders to structure a bond that would not only meet the needs of the market, but also align with the client's financial goals. This listing is more than a financial transaction. It signals Barita's steadfast commitment to democratizing access to the capital markets, fostering financial inclusion, and promoting wealth creation across Jamaica and the region.
I'm pleased that you could be here today for the listing of not one, not two, not three, but 7 tranches of the bonds, Barita bonds on the JC bond markets. And you know 7 is a perfect number, so it is good. We are excited to have BIL, which is a listed company, having listed its ordinary shares on the main market, now listing these bonds on the bond market. And I'll tell you a little bit more about why we are excited. In fact, BIL has utilized all the markets of the exchange, which is a testament to their belief in the stock market, and that this is an avenue for mobilizing capital. BIL listed its ordinary shares on the JC main market on January 14, 2020 at a price of $2.50. Who can remember that? Hardly anybody. And that is after successfully raising $93.65 million. And it seemed like a whole lot of money then. Yes? The stock price is currently 70.41, an appreciation of over 2,700%.
Extremely grateful for the support that got us here. I firstly want to thank investors for continuing to place their confidence in us. I mean, Barita Investments is no stranger to the market. Marlene spoke about our first 4 years into the capital market with our IPO in 2010. But since then, we've returned to the GSE for capital several times. Actually, have done 4 takes at it, Marlene. We would have done 2 rights issues in 2019 actually, in March and September, both oversubscribed. We would have reopened the capital markets in 2020 with our landmark IPO, $13.5 billion. It was, at the time, a very daunting transaction. Therese would have led that transaction, and we would have followed it up the year after with an IPO that raised $10.8 billion. So we're no stranger to the market. I say that to say that our endeavors are built, right, on top of the confidence that investors have continued to place in us. It's not a responsibility that we take lightly. We are fiduciaries of your money. And as our slogan said, we'll continue to responsibly and prudently make that money work for you.
At Barita, we don't create seats. We build launch pads. The Barita Analyst program is where bright minds come to catapult their careers. This program is next level because it goes beyond theory. From day one, you'll rotate across critical departments: strategy, asset management, corporate finance, learning, leading, and delivering value.
When I joined the Analyst program, I thought I'd be doing mostly admin tasks, such as ensuring documents are in order, tidying up files, shadowing my boss, not a whole lot of action. However, from the very first day, I realized this was not going to be the case. I went straight into the action. Over the course of the program, I've done more than I could have expected. I have meaningfully assisted the team in completing numerous deals. I've written multiple research reports that have been published on the company's website, and most proudly and recently, I helped execute one of our biggest deals ever, the Barita bond. I was part of the structuring and distribution of that transaction. I helped to pitch a strategy and craft the story that secured investor confidence. That's real exposure, real responsibility. This program pushed me to grow fast and deliver even faster. It's not just about learning different aspects of finance. It's about playing a key role in strengthening and developing the Jamaican financial industry.
If you're hungry to grow and ready to rise,
Barita is where it begins.
pleasure to welcome you to the Barita Beat, the pulse of our performance. I am Cynthia Thompson, Vice President of Premium Wealth and Corporate Solutions at Barita Investments, and of course, your moderator for this investor briefing. With me today is Ramon Small-Ferguson, Chief Executive Officer of Barita Investments Limited. Ramon is also our Managing Director of Barita Unit Trusts Management Company Limited. Also with us is Stephen Philibert, Group Chief Financial Officer, Dane Broadborough, our CEO designate for the Barita Financial Group, and a first-timer to this briefing, Richardo Williams, Vice President for Asset Management and Research. So our objective today with the Barita Beat is to provide a comprehensive update on our third quarter financial results, which ended June 30th, 2025, and were also published by the Jamaica Stock Exchange website on Friday, August 15th. We will also touch on key points related to our business operations and future outlooks. As is customary, we will open for questions, which should be entered into the Q&A section on your screen. And at the end of this session, we'll make sure that we go through and have a thorough discussion. I will now invite Stephen Philibert to take us through our presentation.
Thank you very much, Sancio. Good afternoon, ladies and gents. We'll start with a look at operating income as usual. So we have net operating income for the 9-month period declining to 6.27 rounded billion from 7.04 in the prior year. So that's a decline of 769 million or 11%. And that's driven primarily by the reduction in gain on investments. So you'll see that on the rightmost part of the diagram of the chart, and that is reflecting the non-recurrence of significant prior gains. So in the prior year, we had some material gains on our real estate exposure. We've commented before that we expect that we will see in the future our performance driven by this area from the development aspect more so than from the revaluation aspect. So this is in accordance with our expectations. So this has been partially offset by an increase in fee and commission income to 3 billion relative to about 2.9, just under 2.9 in the prior year. That's an increase of 151 million or 5%. And that is driven primarily by a strong investment banking performance. Asset management is a consistent performer, but we are quite pleased by the outcome from investment banking. Net interest income is almost flat, 485 million in the current year versus 408 in the prior year. We've seen the trend upwards in that item as the interest rate decline has been reflected more quickly in our assets than liabilities. We also have FX trading and translation, not reflected on the chart, but that item is also an increase to 347 million from 313 in the prior year. That's an 11% increase. We tend not to show it on the chart as a smaller item. Nevertheless, it's positive directionally. So we'll move down to operating expenses, and we're seeing here fairly flat, just up 1%, 31 million to, well, 3.2 in both cases. And we see a decline in staff costs of about 7%, $87 million. That is driven by the continued benefits that we're seeing from the retrenchment exercise that we undertook some time ago, over a year ago now. And administration costs, those are roughly flat. Again, just that 1%, in this case, decrease, 19 million to 2.04 from 2.06 billion. Impairment and ECL, we had a larger write-back in the prior year of 145 million relative to only 10 in the current year. The current year is impacted by two roughly offsetting trends. One is a decrease in the loan portfolio, which would have seen us write back the provisioning relating to that portfolio. But on the other hand, we've seen an increase in the securities portfolio. And of course, we add provisioning in relation to that. So those two have roughly offset for the period. So just minus 10 on that item, minus 10 million on that item. Efficiency ratio sits at 51% for the year relative to 45% in the prior year. But again, this is not really related to a movement in overall expenses. It's more related to that non-recurrence of the real estate exposure income. So the net effect of those two items, you'll see at the top of the table there, net profit after tax, 22% decline to 2.25 billion from 2.89 in prior year. And earnings per share has moved similarly downwards by 22% to $1.87 from $2.41. The balance sheet, those details reflect the movements I mentioned earlier in relation to the ECL provisioning, where we're seeing that loan portfolio decline from 13.3 down to just under 7 billion, offset by the increase of 13% or about $14 billion in pledged assets and marketable securities. So that is the two items that combined represent materially our securities portfolio. So overall net assets, total assets, are up about 7 billion or 5%. And that's funded 5 billion on the liability side and 2 billion on the equity side. So shareholders' equity, you'll see there moving from 35.3 to 37.5 or just over 2 billion. And the total liabilities being up around 5 billion from 107 to 112. That latter being driven predominantly by an increase in our repurchase liabilities. And finally, our capital adequacy ratio, we continue to lead the industry average at just under 25%, industry average being about 20%. And of course, we know the FSC minimum requirement sits at 10%. So with that, I'll just recap here the financial highlights. I almost forgot this slide. So we have net operating revenue, 6.3 billion, net profits of 2.2. We have total assets just under 150 billion, shareholders' equity 37.5. And then we see the efficiency ratio and ROE statistics reference here as well. So with that, I will hand over to Richardo to take us through the macroeconomic context.
All right, thank you, Stephen. And good afternoon, shareholders. So the purpose of this presentation here is really just to provide the overarching context of the numbers that Stephen just outlined, and to provide a bridge to Ramon's eventual presentation that will get more into the actual investment strategies that have produced the outcomes that Stephen mentioned just now. So the first macro aggregate that we really want to focus on here really are central bank policies and the continued concerns about inflation that ultimately drives the interest rates across all economies, ours included, obviously. So the most recent one is the Monetary Policy Committee of the Bank of Jamaica recently met and maintained its policy rate at 5.75% in August and effectively reiterated its commitment to price and FX market stability. In essence, what this means is that even though the headline figure came in at 3.3%, which is below the BOJ's target range of 4.6%, there is continued concern about imported inflation, given the prevailing tariff umpire that is currently taking place in the US and its main trading partners. So there is that background context that the BOJ is concerned about, and which is why it would have decided to maintain the policy rate at 5.75%, even though the headline number came in at 3.3%. When we're looking outwards the next 8 quarters, the BOJ is anticipating that rates, that is inflation, should be in the 4.7% range. And effectively what that means is that to the extent that imported inflation actually doesn't materialize, then the possibility exists that we can see some further rate cuts, as is the expectation of the US Federal Reserve. The primary implication for our business, and we will see that in the numbers, as Stephen has just outlined, is that with inflation being pretty much anchored and the FX stability being pretty much maintained, it supports some degree of carry in our business and reduces what we call value at risk shocks, primarily in our treasury and trading business, while helping to credibly anchor our asset management inflows. Also, that came out in the numbers that Stephen mentioned just now. It will also help to keep our NII spread, that is our net interest income spreads, fairly well behaved. And as you saw in the numbers there, year over year, that has now pretty much stabilized. And Ramon will definitely give more insights there. But that is the macro backdrop that is giving cause for these numbers. In terms of economic growth and how that is composed, GDP numbers came in, or rather is forecasted to be at about in the range of 1 to 3% for the financial year 2025 to 26. And the near-term average out through to June of 2027 is about 1.6%. So these are numbers that were produced by the central bank in its most recent quarterly monetary policy report. The primary sectors that will drive these remain our services business, our services sector rather, tourism in particular. Mining and quarrying is expected to have some positive output here, particularly as the capacity and utilization in those areas of the economy begin to churn at a much higher clip. In terms of the actual quarter corresponding to our financials, that is the June quarter, the demand was a bit mixed. We saw some investment expansion in the economy, in particular public infrastructure and some FDI inflows. But the overarching theme here is that growth continues to be somewhat underwhelming in the local economy, and the implication for our business and how we are positioning is that we will continue to favor debt issuance, particularly refinancings. That is something that we have been observing in the market, because that is essentially how the interest rate dynamics is actually supporting those kinds of capital markets actions, right? And we are anticipating more credit type asset management products in contrast or in preference over what we call high beta local equity risk. And again, we're seeing that in terms of the performance on the local stock exchange, where all of the indices in the recent quarter declined. Now, it is very important for us to understand that in contrast to some of the more developed markets, such as the US in particular, which is more quote-unquote efficient, our market is not necessarily reflecting the fundamentals of the companies that are reporting. Our data show that from as early as March of 2023, most companies on the junior stock exchange and the main market exchange have actually recovered in terms of their earnings and top-line revenues, that is to pre-COVID levels. But yet, in terms of their valuations, they are being treated as though we're still at the peak or the height of the COVID days. So what that means is that investors who certainly have a long-term orientation and we might sound like a broken record here, but it is really investment fundamentals. If you have a long-term orientation, you can in fact take up some pretty good assets that are trading at almost distressed valuation levels, distressed quote unquote. So that is pretty much the outturn there where growth and demand is concerned. In terms of the FX market, we saw a bit of depreciation pressure in the quarter, particularly in April and May, and a number of things drove this. One was the continued global uncertainty. There was also this, what we call the psychological threshold breach, that is the weighted average selling rate exceeded $160 to 1. And importantly as well, just in terms of how we value currencies, there was a narrower interest rate differential with respect to the US. Now, what the BOJ did was it intervened a couple of times to bring some level of stabilization and normality into the market, effectively selling over 345 million US in the quarter. And what that meant is that it eased the pressure on the local currency. What does that really mean for us? It means that we have more stable FX translation gain income, and we saw that again in the numbers that Stephen presented year over year. That is an outcome of effectively the BOJ's intervention to stabilize the market, as well as just the general dynamics in the FX market. So how are we positioning, and what should businesses in the real economy do? We have to remain nimble, particularly around the BOJ's supply actions, and also the near-term pass-through risk, right, that can influence our translation gains and losses, which we believe we're managing pretty well on a year-over-year basis, as the numbers demonstrate. And the last point that we really want to share with you here, just in terms of the macro context and strategy, pertains to the rates markets. So the JMD money market and GOJ T-bill yields declined quarter over quarter in the last, for our quarter ended June. So the long end of the yield curve eased versus March of 2025. So the carry environment is improving slightly. I'd mentioned at the top of the discussion that local equities fell in the June quarter, the JC main market by 3.9%, the combined index by 4%, and the junior market by 5.4%, driven primarily by the continued global uncertainties. That's one. And two, there is a change in investors' preference for USD type investments, which currently are yielding a little bit more than the domestic currency investments. So that is something that investors can keep in mind as you look to evaluate even the performance on, say, our asset management side of the business, and those that are facing the local assets. That is a primary driver there. In terms of the global context, the Fed also met in July and held its policy rate at between 4.25 to 4.5%. We anticipate a further 25 basis point cut in September. They meet on the 17th of September, and the futures markets are currently pricing in an 87% probability that the Fed will reduce rates when they meet then. And further out into October, the rates markets are also suggesting by a 43% probability that there could be a further 25 basis points cut in October. The implication here is that given the fundraising that we did in the last quarter, it is giving us the capacity to pivot to more predictable revenue line items. It also gives us the flexibility to redeploy into higher yielding assets. And further, the environment is moderately supportive of our net interest income line item as the liabilities reprice downwards And while the liabilities reprice downwards, we're redeploying into higher yielding assets. And that will bring some degree of stability and growth to our NII, again, as the numbers demonstrate. The market environment continues to favor fee income, which we have a preference for, particularly those with recurring features. And those will continue to remain a core growth area for the business as the macro environment effectively supports. So that, in a nutshell, is the macro context which supports our strategy. And Roman will now take us into even greater details.
Thanks, Richardo. So I think Richardo set an excellent backdrop against which we've set our own strategy, right? And I just want to remind you, stakeholders, of our strategic pillars. There are 5, right? And really, you know, we've really been focused over the course of the last 18 months or so on a focused execution agenda centered around these pillars. The first is customer or client centricity, right? And our focus here has really been to the 2 things, and it's a work in progress, right? The first is to get a deeper understanding of our client needs. And the second is to seek to make doing business more efficient, more effective, and, you know, really kind of enhance the overarching client experience, particularly through advancing our technology. And work has been done on that, and there's a lot of work being done below the surface. And the hope is to bring that most prominently to fruition in the next couple of quarters, right? We have been focused as well on optimizing our business lines, right? We have 4 main business lines, and the focus has really been to the 2 things. The first is to reduce overall volatility in our performance by improving the repeatability of our revenue generation. And the second is to refine the revenue mix by being very deliberate about the percentage of revenue that each business line contributes. Against you know, the kind of base set by being more client focused and optimizing the business, we've been steely focused on driving operating efficiency and excellence, and we define that as boosting productivity, right? So enabling our resources to produce more without demanding more through automation and optimizing our resources. We're also trying to streamline our overall processes and ensure that they are focused around our strategic initiatives. The 4th pillar, risk and compliance. I mean, this is really ensuring that we safeguard the enterprise even as we seek to grow, even as we seek to generate revenues and by extension profitability. We've been strengthening our risk compliance and other assurance frameworks all across the 3 lines of defense. And we've also been ensuring that we're staying abreast of the evolving regulatory environment and working with the regulator as a partner. Finally, we're seeking to scale the business even beyond our organic capabilities. We've been driving, you know, strategic alliances and seeing how we can carefully expand our presence to regional markets, even if we don't have boots on the ground, right? And the all-encompassing set of objectives that, you know, these strategic pillars are meant to achieve is building a more resilient business, building a more agile business, and by extension, driving sustainability around our value creation, right? We're not trying to be tactical, hence these strategic pillars. Now, there are a few drivers of our performance, right? We have our internal strategy, but it is within a context, and Richard has spoke about some of the macroeconomic factors that are central to our overall business performance, right? And it's set right there in the external factors. The less restrictive monetary policy backdrop is certainly a tailwind for us. The stable longer-term growth outlook, despite the fact that growth is expected to be muted in the near term. The regulatory environment, I mentioned the impending changes brought on by Twin Peaks and Basel III. Internally, capital management is still central to how we operate and how we execute our strategy. And the efficiency and excellence on the operational side is meant to optimize our cost base. Right? So in terms of our operating revenue, and I'll get into the various verticals or business lines of the business shortly, we are expecting a more robust recovery in our net interest income. Year to date, things are a bit flat, but that is largely because of certain one-off factors, which if they had not occurred, would have seen net interest income up over 20%. Right? We want to expand with respect to investment gains, more so from traditional asset classes as markets recover. The real estate platform is in transition, and I'll speak more about that in a moment. And we intend to seize the tailwind from the shift in monetary policy. So let's talk about the different business verticals and what that means for the outlook and what it has meant for the performance year to date. On the investment banking front, which is the first business line that I'll mention, Stephen mentioned that this business line has actually recovered very significantly year over year and is an outperformer with respect to our revenue stack year to date. And going forward, we're really focused on executing on a strong mandate pipeline that we've built across structured finance and capital market type transactions for our corporate clients, both here in Jamaica and within the region. People are seeing Jamaica as the mecca for fundraising within the region, and we are, as a business, seeking to be accommodative around that. We're also going to be leveraging the shift in the monetary policy environment with lower rates and more investor activity. The hope is that this will drive deal flow and really allow us to be more competitive with respect to our funding structures. Finally, we're seeking to expand our advisory capabilities. We have now built up an institutional bank of sorts of several transactions, and we want to monetize that expertise not only through the fundraising element of things, but through advisory. On the treasury trading and brokerage side, it's critically important for us to systematically capture the gains that Richardo mentioned that have come from lower funding costs on the liability side, with those liabilities repricing downward with the rate environment evolving, right? And the expectation there is that that will improve our spread income in quarters to come. We have seen an uplift in trading volumes, and we're expecting that to continue as well. And, we have built up very good risk capacity with that strong capital base. And as we optimize our assets, that will build our risk capacity even further and put us in a position to take advantage of increased trading opportunities. Finally, we're prioritizing in a go-forward way structured product distribution off our balance sheet and other alternative funding structures to really give us greater flexibility on the asset side. Right? On the asset management front, AUM is up 12% year over year, with total assets under management across discretionary portfolios and client-related assets up to just under 405 billion, right? And that has been supported by inflows of assets from clients, improved fund performance, and so on, right? And in this business, we're really looking to do a couple of things to really drive growth in AUM going forward. We want to expand the available suite of options for our clients in terms of our discretionary portfolios. And we are looking to go after, larger mandates, so to speak, to expand the amount of assets under management and the number of people we can reach via this business. Right? We're also targeting investors who are looking to diversify their portfolios in the face of lower fixed rates, right, with the monetary policy environment evolving. The final business line that I'll speak about is the alternative investment business line. And the first item on the list there, as I introduced before, is real estate. We have made some material advances in progressing our strategy on the real estate front to now a development phase. As Stephen mentioned previously, we were in the acquisition phase, and we would have benefited from how well we bought in that acquisition phase via revaluation. And that progress has been marked by a few milestones being breached. The first is that we have been cultivating our talent internally to manage this. And the group has identified and secured a commitment from someone who will lead the real estate thrust of the business. The second element of things is that we have progressed significantly development plans associated with several of the parcels of real estate. So it's our expectation that the 2026 financial year will be marked by not one, but at least two developments commencing. Right? Along this business line, we're expanding our private equity and private credit strategies. Right? And it's a diversification play, but we believe the market environment warrants ramping up these exposures. We believe that there are credible exits available for these asset classes via the Jamaica Stock Exchange in particular. And we aren't being gun shy at all in this space. Finally, we're looking to leverage improved liquidity conditions and the steadily improving market sentiment to position our portfolio for higher value exits. So let's talk about funding our growth. Right? Richardo mentioned the landmark Barita bond, which would have been launched in Q2 and would have been concluded in Q3, where we raised over $20 million was raised, and we accepted 20. And we raised actually 4.7 billion Jamaican dollars. I'm seeing 3.7 there, for a total fundraise of just under $8 billion. This is the largest JSE listed bond to date, and it has allowed the company to really position along a few strategic lines. We did a minor debt refinancing, but has strengthened the business's liquidity and will be supporting our execution in relation to that investment banking pipeline that I mentioned. It's actually started to do so already. We have been acquiring assets in the strategic portfolio, and it has provided additional float for our trading team as well. And to remind you, a prelude to our precursor, rather, to this bond issuance was our Caracas rating exercise, which concluded in us being rated A+ on the local currency national scale. And with that, I think I've concluded talking about the strategy of the business, and I'm going to hand over to Dane, who will give us some more insights into broader group-related matters.
All right, thanks, Ramon, and good afternoon, investors. So as I reported in the last quarter, now having completed our reorganization, so we're now finalizing the licensing process, after which we expect Barita Financial Group to become a financial holding company licensed by the Bank of Jamaica. And as I mentioned, this opens the door to deepening some strategic synergies, particularly surrounding operational efficiency, customer experience, and governance and risk management. So overall, it really gives us a strengthened platform to optimize the management of the group's resources and give expanded and improved customer experience. Now, so Ramon spoke about the strategy of Barita, and the strategic pillars for Barita pretty much remain aligned to the pillars of the group. So again, really the optimization of our group's internal structure to unlock the synergies that we spoke about is the core of our strategy as we look to build a seamlessly integrated financial group. The intended ideals of that reorganization surrounding in particular customer centricity and efficiency really permeate from the overarching strategy of the group and into the subsidiaries, including Barita. Now, meanwhile, throughout the group, of course, including Barita, we continue to implement the necessary initiatives to make us innovative by design, again, making continuous improvements as a standard part of the way that we work, and to maintain and improve our strong governance and risk management framework, really further infusing our risk culture throughout the organization as we ensure ownership across the three lines of defense, in particular our very expansive first line. Now that, in addition to ensuring our resilience, is going to ensure that we're well positioned to thrive within the evolving regulatory environment. And of course, we look to continue to make the group a great place to work and build organizational consistency around some key non-negotiable ideals of our group. And finally, the general optimization of our financial resources to ensure that we evolve towards our ideal business mix, our ideal asset mix, and our ideal funding structure is the final element of our strategy for the group. So the initiatives around in the bond raise, around inorganic expansion, both contribute to that initiative, and it's complemented by the day-to-day management of our resources. So as I mentioned, as we contemplate our one group dynamics, we expect the reorganization to unlock significant benefits, particularly through, and I mentioned this a few times, customer centricity and efficiency. Right? Customer centricity, as you look to organize the group around our customers and look to have our clients have full seamless access to the various capabilities of the group and allow us to curate specific customer experience models and standards for our segments, all with the common thread of the key tenets of the Barita experience surrounding expertise, accessibility, trust, and responsible evolution. And of course, efficiency, as we streamline units and optimize the key delivery of services to our clients for operational efficiency, and unify best practices and standards across the group for operational excellence. Now, as we look to grow organically and inorganically, our capital base is going to continue to be the springboard of our growth. Now, this is what enables the acquisition element of Barita's strategy and will be the foundation for augmenting our earnings in the future. So in addition to the existing business and its ability to generate earnings, you, our shareholders, are really investing in Barita's capacity for growth. Right, so the capital base continues to be a feature across our group. In addition to Barita's capital adequacy of 24.9%, which is second among securities dealers and well ahead of the regulatory minimum and early warnings of 10% and 14% respectively. And the corresponding capital base, which accounts for over a quarter of the securities dealer capital, its sister company CTMB, or Cornerstone Trust and Merchant Bank, has the highest capital adequacy ratio among deposit-taking institutions. And similarly, this will support its growth as it pursues its digital strategy, consistent with the technology investments across the group, including Barita. So in addition to being the fulcrum of our resilience, our capital base is really the springboard that will allow us to continue to deliver strong earnings while maintaining the assurance of stability. Now, notwithstanding the resilience that's embedded in our capital base that provides strong buffers to shocks, through our thrust for continuous improvement, we continue to work to ensure that our risk exposures are reflective of our deliberate strategy and as defined in our risk appetite. So our risk framework speaks not only to the risk that we try to minimize, but defines where we have the appetite for the type of risk that will advance key elements of our strategy. So in addition to the investments that I have spoken about in prior investor briefings that we've made over time and optimization of our governance frameworks, our strategic ideals are built on a deliberate foundation of risk governance and controls, which will allow us to continue our focus on risk ownership at the first line of defense and the permeation of the risk culture through the risk owners and across the organization, while achieving the ideals of our group structure in optimizing the efficiency of our governance and maintaining positive client experiences as we manage our risks and comply with regulations. So again, as you think about Barita, and you think about it in the context of the Barita Financial Group, the core of our competence and identity will be along the lines of innovation, risk management and risk capacity, and customer centricity. So innovation, as we look to organize ourselves to structurally deliver on continuous improvement and proactively meet the needs of our clients while optimizing our efficiency. Maintaining financial resilience through above average levels of capital and operational resilience through our governance and control environment, while using our risk capacity as a springboard for our growth. And finally, organizing ourselves and our operations around our customers and taking deliberate steps to institutionalize the elements that allow us to listen intently to our customers and respond to them, leverage our expertise and our institutional capacity to exceed their expectations, and ensure memorable interactions with our group. So with that, we look forward to answering various questions you may have.
So thank you very much, gentlemen. While you were talking, I'd love to let you know that the question and answer segment has been abuzz with a lot of questions. So I hope you're all prepared to answer. All right, so let me kick it off first. Let me direct the first question to Stephen. Stephen, your question is, if salary and admin cost is down, why is your total operating cost high, and what is driving that increase?
All right, thank you for that question. Just a moment, let me click back to the appropriate slides. I think that will help us to follow the numbers. Okay, here we go. So we have a movement in the ECL and impairment right back. So that has decreased by about 135 million from minus 145 in the prior year to minus 10 in the current year. So that is effectively an increase in expenses. And I'll talk about the concept of a negative expense shortly. But for now, let's just follow numerically. That's an increase effectively of 135 million. Then in staff costs, we have a decrease of about 86 million, and administration costs decreased by 19. So the total of those two, the staff costs and the administration, is about 105 million. So when you subtract the 105 from the 135 movement on the ECL, you're left with a net movement of about 31 million, subject to rounding. And that is the total movement that you're seeing, the total increase that you're seeing in operating expenses. So just to speak briefly now about that negative expense item, what does that mean to have a negative expense? Well, the impairment ECL item is really reflecting the amount of provisioning that you're doing, that is risk against not collecting fully on your financial assets. So the accounting rules require that you don't wait until there's a problem with collectability in your financial assets. The accounting rules require you to estimate the risk of that happening and estimate the impact of that happening, and you make a provision against the possibility of something going wrong with collectability in the future. So I mentioned earlier that in the current year, that right back being a reduction of that provision, right back of 10 million in the current year, is really offsetting two things. We saw that reduction in the loan portfolio, which means all of a sudden you don't need to be carrying provisioning against collectability risk on such a large loan portfolio. So that would have led to a larger write back. But then we saw the growth in the securities portfolio, and you have to make some provisioning against risk that comes with those securities. So that's how you have the two items offsetting to roughly flat in the current year, just a small 10 million. And then we had the larger one last year. So I just wanted to take some extra time to talk about that concept of a negative number in expenses, because I know it's not necessarily intuitive.
Okay. Thank you so much, Stephen. Ramon, the next question as it relates to our performance has been, and I've seen a number of questions as it relates to dividend. Investors want to know, should we expect any dividend payments this year? Are those payments expected to be an increase of sorts?
Yeah, so I think this is a popular question. I actually got it last quarter. So the trend that we have set as a business is to share, from a profitability perspective, the returns with our investors via a cash dividend. Our dividend policy is really rooted in our overall capital management policy, right? And that's really underlined by our risk management framework. So we take a risk-based approach. We look at several factors in determining if we should recommend a dividend to the board, the quantum of dividend, the timing of dividends, and a few of them are, one, what's going on in the operating environment, two, the nature and size of profitability within the business, the state of our capital base, and so on and so forth, right? That being said, taking account of all of those factors, we are seeing, despite uncertainty in several segments of the market, we're seeing relative stability. NT has been profitable year to date. So management is really assessing all the various factors, and at the appropriate time, we'll take a decision to have a conversation with the board dividend payments for this year. That will determine the if, first and foremost, the timing and the size. And the size tends to have a correlation, a strong correlation with the state of profitability, both past and current year profitability and retained earnings. So that will give you some signal, let me put it that way.
Okay, great. Thank you so much, Ramon. Richardo, I'm seeing a number of questions in the chat as it relates to our managed funds. There are some concerns as it relates to their performances, especially as it relates to the Capital Growth Fund. What assurances or insights can you share with our viewers?
Okay. Thank you for that question, Sansio. So I'll start first with maybe the Cap Growth Fund, since that is top of mind for most individuals. The Cap Growth Fund is designed to take almost 100% exposure to the local equities market. In other words, so it has a high beta exposure to the local equities space. And as I indicated just now, if we look at just the recent quarter, all the indices were down, the main market, the junior market. And it represents a continuation of the local equities space in terms of its underwhelming performance relative to other indices globally. The S&P 500 is an example since 2020. Now, what does this really mean for the Cap Growth Fund? We do not expect a sharp turnaround in this fund until the relative attractiveness of US dollar assets change compared to Jamaican dollar type assets. And I showed that in the macro environment just now. What it means from a strategy perspective for us is that we continue to do a number of things. One, we are changing the actual allocations in the fund subject to market liquidity, etc., which remains fairly thin. That's one, to effect immediate change in the fund. That's one. And two, from a valuation perspective, there continues to be, as I indicated, really solid companies that are available at almost discounted prices for sale. So we continue to appropriately size those opportunities. And we anticipate that once the cycle changes, the fund will actually change. So that is what we can do on our end in terms of the Cap Growth Fund in particular, right? We are effectively constrained by the local macro dynamics. Now, in terms of the broader and larger set of funds that we are managing, I think we are doing a pretty good job there. If we take the FX Growth Fund as an example, which has, again, a very high beta exposure to international equities, year to date, that fund is up over 20%. It ranks number one amongst its competitors. The same obtains for the FX Bond Fund. Again, that gives exposure to a wider set of assets outside of Jamaica. So the overarching point that I would give to our investors, or at least what I would want to resonate with them, is that we have to invest in the funds in a portfolio context, right? Because if, say, you had invested in 3 of the funds, to include the cap growth fund, you will be effectively in a net positive position, given the fact that the FX growth fund and the FX bond fund would have provided the shock absorptive capacity, as it were, in your fund, or in your portfolio rather, when the cap growth fund is showing, the losses. So that in a nutshell is how we would answer that question, Sansia, and how we would advise investors to position going forward where the funds are concerned.
Okay. Follow-up question before I move to Ramon. There is a question as it relates to the performance of the stock market, of the stock on the JSE. Clients want to know, what are we doing to make sure that the price is higher than what is currently trading at?
That is the Barita stock?
The Barita stock.
So we cannot do anything to influence the Barita stock, right? We, like any other listed entity, we are at the mercy of how investors choose to invest in the stock, right? Now, if we look at this just from a fundamentals perspective, price is what obtains on the exchange. Just like if you're going to the market in Coronation, just for argument's sake, and the market lady is selling a pound of tomatoes for $50, right? You have to take it, right? But you might be of the belief that a pound of tomato values 100. If that is your view, you should buy the pound of tomatoes at 100 and go elsewhere and make a profit, right? So we cannot influence the price of the stock in that way. In fact, it would not be prudent to do so. What we continue to do, as Ramon, Dane, and Stephen have pretty much done in their presentation, is to show how we are creating value for our investors. And eventually, as we know investments, value and price eventually must reconcile.
Thanks for educating us as to what really happens as it relates to the price movement for our stock. Ramon, there are a number of questions as it relates to our real estate portfolio. Investors and clients alike are interested to find out when they will see real movement. Where are we as it relates to the assets we would have purchased? Are we at pre-development stage, development stage? When do we plan to start getting some real returns?
Thanks, Sansia. So I would have mentioned this a bit when I was talking about the different business verticals, but just to reiterate and maybe get a little bit more specific. So having concluded the acquisition, we're now, as you described it, at pre-development, right? And that means doing a few things, and a main part of that is planning. And we know real estate developments take a lot of work to put together, given the complex nature of some of them, and given the approvals involved in bringing a concept to a stage where it can actually be developed. So I mentioned the fact that we've made progress with respect to talent. I mentioned the fact that we've made progress with respect to planning. And we have also put together funding plans with respect to a couple of these developments. So our expectation, again, subject to us concluding all the various approvals, we will be building in financial year 2026. And we've identified at least 2 sites where we're going to be out of the ground with respect to that portfolio. And just to remind everyone, there are 8 properties in the portfolio which aggregate to about 7 sites, and we expect major activity in relation to 2, and we have another 2 that I think that by the tail end of next year will be more concluded around exactly what's going to happen there.
Okay, great. During your presentation, you spoke about inorganic growth. A question here is, can you provide more details on the kind of inorganic growth you're pursuing? Are you at liberty to speak about the partnerships, markets, and if there are any opportunities for acquisitions?
Yeah, sure. So I'll kind of break that into two, right, which is acquisition and strategic partnerships. Reacquisition, the business has gotten to a point where, given our scale, a big part of us achieving meaningful growth over the course of the next cycle, next 5 years or so, could mean that we need to figure out how we acquire or combine with respect to aspects of our business or the business as a whole. So we're frankly looking out for those kind of opportunities to be an aggregator of sorts or a consolidator in the space, given our relative size and the fact that we've built this platform and the efficiencies that could come from something like that, right? So eyes wide open with respect to those opportunities. In this market, they are few and far between, and we're trying to position ourselves to be at the table for every one of those possible conversations, right? Now, strategic alliances, we're looking at them in a few forms. One is, of course, looking for qualified referees who can actually introduce us and connect us with leads that are likely to transact, right? And that has been a general feature of our business, but we've translated it to a much more structured feature of our business, and it is now, frankly, a real dedicated channel of business that has been coming to us, right? And through that medium, we are seeking to credibly ramp up the number of transactions that emanate from markets external to Jamaica, right? Whether it's funding transactions via the capital markets, the investment banking team, or those looking at Jamaica as a possible place to invest, particularly sophisticated investors. So we've been effectively building out those channels to allow business to flow in for us via those strategic alliances, and it's borne some fruit in 2025, and we're really trying to see how we can expand that in 2026. Just to kind of close out our approach to collaborating locally as well, we've recognized that as a business, we can do a lot more by collaborating even with our peers, our competitors, right? And I think the execution in relation to even the Barita bond, which we closed in May of this year, exemplified that. We would have collaborated with a number of our peers in the space as selling agents, and they would have been credible channels of distribution for us. And we kind of sought to set things up a little bit differently, where they were central with respect to the publicity around the offer. And that's a model that we are seeking to carry forward, right? To ensure that we don't need to carry the burden of a transaction forward alone. We can collaborate with our peers and get more done, get it done faster and more efficiently, and expand the pie for all of us in the space.
Thank you so much. With Barita having so much client data, what assurances can we give our clients about the data protection systems that we have in place, especially as it relates to the Data Protection Act? Stephen?
Thanks, Antia. I'll take that one, yes. So there are two elements here. So there's an element regarding cyber risk, and then specifically around our Data Protection Act here in Jamaica. So let me discuss cyber risk first. So the first thing to realize is that in our industry, we are among the most targeted, if not the most targeted, simply by virtue of the fact that we have so much in the way of financial assets, and frequently we'll be conducting transactions in large volume and in large value. So with that known and understanding the kind of expertise that is being brought to bear by cyber criminals, the first thing that we have to do is make sure that we have equivalent expertise on our side. So we've made very robust the level of expertise that we have internally in terms of our own IT personnel. And we've supplemented that by retaining on a contract basis external experts who are globally recognized for their skill set as it relates to cyber risk. Technological protections, so the use of things like firewalls, encryption in how we store data, access controls. We've improved company systems such that they will not allow non-company devices onto them. We make use of appropriate permission levels to make sure that any person who, let's say theoretically could come onto the network would not have the permission levels required to cause harm in serious ways. Strong password management and the use of multi-factor authentication in our systems. All of these are ways that we mitigate against that risk. We also test to see that the measures that we have in place are robust. We do penetration testing and ensure that we mitigate any weaknesses that testing highlights, as well as audits of our controls on a regular basis. So that's technological, but then we also have the human factor, which, as we know, is perhaps the most important. Quite frequently in cyber risk events, it's the human element that's been the weak link in the chain. So we're very serious about constant training. We're very serious about simulated attacks to see how the team responds to it and to see where we need to upskill, reinforce the training, those kinds of things. So that's as it relates to cyber risk. And then also the question touched upon our Data Protection Act locally. So with the Act coming into force, we embarked upon a comprehensive project all across our entire group to ensure that we have an appropriate posture as it relates to data protection across the organization. We have the kind of systems and understand, where does data reside? How is it that we're processing it? Are we making sure that that is minimal relative to the justified needs for processing based on our activities? And also registering all of this information with the Office of the Information Commissioner, which we've done. So both Barita and its subsidiary BUTM are registered with the OIC. And we continue to improve. It's never a project that you can say has been completed. It's something that you're always seeking to improve that posture.
Great, thank you so much. We have so many questions, but we are really out of time. We'll just take one other question, and I will direct this question to Ramon. What were the drivers for the nearly 50% decline in Barita's loans receivables?
Sure, good question. So, I'd start with kind of giving a background of how we see loans in the context of our business. There are really two major categories of loans that we do, right? The first is that we have client-related loans that are largely associated with their portfolios, margin loans that facilitate them being able to augment their investing capability, right? So they borrow against their portfolio and they use that money either to invest further or, for other incidental needs, right? The second category are loans that are largely incidental to our investment banking business, right? Some of those loans are full-term loans that are most times supported by dedicated funding. So as an example, we are an authorized financial institution by the Development Bank of Jamaica, and we definitely focus on granting growth-inducing loans by that window, right? Another element are transitory loan type transactions that tend to terminate in an investment banking deal. So we may give a bridge loan for a temporary period of time, and then there's an investment banking transaction that replaces that loan. So that's the background. The sharp decline that was registered in the loan portfolio was the result of, one of the strategic verticals that I mentioned, that optimization. We're really looking to optimize the assets on our books. So that loan portfolio would have been replaced with bonds, with securities on our books via a transaction that saw us selling those loans and replacing it or redeploying the funds into securities. And it's really just us increasing the turnover with respect to our assets, which some will know asset turnover is a big component of generating return on equity. So it's really not a fall off in that business activity at all, but a deliberate initiative on our part to sell loan portfolio to give us capacity to go again.
Okay, great. Thank you. So we are out of time, but I invite, for those questions that we didn't get an opportunity to respond to this afternoon, please send those questions to us at questions@barita.com. For any questions as it relates to investment opportunities, you can direct those questions to makingmoney@barita.com. We want to thank you once again, ladies and gentlemen, for your attention and thoughtful participation throughout this afternoon's briefing. We have now come to the end of our Q3 investor briefing, and we truly appreciate the time you have taken to join us this afternoon and for engaging with us in such a meaningful way. If you missed any part of today's presentation or would like to revisit the details, you can access the full session at barita.com/beat. And if you aren't already following us across our social media pages, please do so by entering Barita Investments on Facebook and Instagram. We look forward to hosting you again, where we will present details on our annual performance. And don't forget to stay tuned for all things Barita by following us on our social media pages. We wish you a wonderful rest of the day.
This listing is a